We're going to kick it off with Karen Kaiser, and she is going to speak on the many benefits of the HECM reverse mortgage line of credit. And the HECM reverse mortgage line of credit is the best kept secret of having a reverse mortgage. This aspect alone should be the top reason for obtaining one. So Karen says, let's dive deeper into all of the benefits it offers. And I'm just going to give a little bit of background about Karen. Karen is a Learn member. She's a senior mortgage advisor and reverse mortgage specialist. She's been a loan originator since 2001 and has held a real estate broker's license since 2006. She currently works for Capital Loan Associates based in San Diego, California, and she is personally licensed for loan origination in Idaho and California, and she's the branch manager for the company. Karen originates and advises on all residential loan mortgage loans, both forward and reverse. Prior to 2001, Karen served as a San Diego police officer for 9 years in patrol and as a detective for 10 years, 3 of which were in the sexual assault unit. Karen has always had a passion for serving and protecting the interests of others. She and her husband, Mark, also a retired San Diego police detective, moved to Star, Idaho 5 years ago from Southern California, and they have 3 sons who live all over the world. Karen enjoys working out, travel, and is an avid golfer. So take it away, Karen. Thank you for being here.
Thank you, Mary. I appreciate that. And so I want to focus on this amazing tool. This is just this is the gold of reverse mortgages, which is the line of credit growth feature that's in there. And Dara, you can go to the next slide, please. So this is, having a financial aging plan. I say this because retirees, of course, most plan for retirement, but a lot of times there's gaps in that retirement and actually don't include the actual aging aspect of that. They don't consider that until years down the road. And in 2023, as of right now, we have over 10,000 baby boomers turning 65 every single day. That's like an incredible statistic. And the average lifespan of a healthy 65-year-old is 20 plus years. And people, when they've planned for retirement, haven't always considered the longevity of that aspect. 1 in 5 baby boomers have no retirement savings. Many are income challenged, but have house wealth. So they have a lot of equity position within their real estate. Some are over encumbered in real estate, no more than 1 property, but yet they might have some income challenges monthly. Number 1 concern of retirees right now, and you will hear this from all financial advisors and financial planners, is outliving their money because of that situation. Dara, next slide, please. So the HECM line of credit, there's some advantages. I've just named a few in this to using this as a financial planning tool. It's great for wealth management. And in working with financial advisors, which I do quite often, these are the pieces of the puzzle that come together. So the funds that are left in the line of credit do not count as a debt against the homeowner. So until those funds have been accessed, they're not accruing any mortgage interest and no mortgage insurance. So they're not costing the homeowner anything by having this line of credit in place for them. So going on down to the growth aspect, the funds in the line of credit, this is the super cool part. They grow. They don't just sit there and die off, they grow. Okay, this is a very exciting feature. They're not earning interest, but they are growing at the same accruing interest rate assigned to the loan balance itself. So for example, if the loan itself is assessed to a 6.5% interest rate, your line of credit is growing at 6.5 plus another half, which represents an FHA mortgage insurance piece on a monthly basis. So this line of credit is going to continue to grow for them over time. Again, they're not earning interest, it's just growing. And this is a fabulous hedge against inflation, because as the interest rates rise, the amount the borrowers accrue in the line of credit just continues to grow faster. The line of credit funds are not subject to income tax. This is a loan. So when people withdraw cash out of this line of credit, it's not a taxable event to the individual pulling it. Next slide, please. Again, it's open-ended. If they use the funds from the line of credit and then make a payment back to the line of credit, they reuse it again. And it will continue to grow at the interest or on the interest rate assigned to the loan balance at that particular time. So they can use it, pay back, reuse it again. When they make a payment, it just decreases the loan balance and increases their line of credit. It is cash home equity. The average time to get this cash in hand is about 5 business days following a written request to the servicer. The line of credit funds are considered pledged funds. What this means is that if somebody's estate planning, they can't rely on the line of credit monies that have not been withdrawn. They can't give those away or will those out. Okay, only the homeowner borrower can access these funds, but once they've been withdrawn, then they can be distributed. But the homeowner borrower has to be the one to draw these funds out. Until they've been accessed, they stay in the line of credit and cannot be willed in that particular format. Next slide, please. The line of credit balance can exceed the market value of the home. This line of credit grows independent of current market conditions. It grows independent of the market value. So this is something that's extremely important when it comes to long-term planning. Because if we have declining real estate values that occur during a particular market climate, this is in a safe space. It's going to continue to grow regardless if their home value goes down. So they can rely upon this over time. The LOC funds grow regardless. And if you can all recall 2008, I know I was working in this industry in 2008. And when we're talking about the security, which is the next line here, it's not capped, reduced, frozen, or terminated due to adverse market conditions or declining property values. And in 2008, that was not the case for people that had forward home equity lines of credit. Those were cut off, many called due. The lenders were wrapping them up, tying them down, and did not allow access for the borrowers. That will not happen with a HECM line of credit. The borrower's funds are secure regardless of adverse market situations. The line of credit can be obtained even with the reverse mortgage HECM for purchase. So a lot of people think that the line of credit is only available to somebody that's doing a refinance and or taking out a reverse mortgage on a zero balance mortgage at the time. But you can actually overfund a reverse mortgage for purchase. So a senior that wants to buy a new home and wants to have this line of credit growing for them can overfund that so that the line of credit can continue to grow for them as well. Next slide, please. 10 ways how the line of credit funds may be used. Sometimes people don't think about the true intricacies of how these funds can be utilized in more ways than just travel, leisure. Those things come to mind: home repairs, planning for an emergency fund. But there's several in here that sometimes don't come to mind that really should be. This reverse mortgage HECM line of credit has an amazing gift to be utilized in a lot of these other aspects. Providing a living inheritance. You know, a lot of people that are receiving inheritance would love to do it when the person is still alive, so that person can actually enjoy or be a part of the joy of giving that gift. So utilizing it while you're still alive and accessing those funds is an awesome opportunity for your family and your heirs. I'm sorry. I know I'm going quickly, but I want Dawn to be able to get in here too, and then we can answer some questions at the end. Reducing mitigating income and estate taxes. These are non-taxable withdrawals, as I've stated. You can control your adjusted gross income by supplementing income with HECM funds instead of taxable or tax-deferred retirement income. You can reduce home equity and strategically invest it in tax-sheltered options, reducing the equity, therefore reducing estate taxes. Again, I would reiterate what Mary stated. Always consult with your CPA, financial advisor, and tax preparer. But these are discussions I've had with these professionals in the past, which is why I'm I'm stating this information. Filling in retirement gaps. I'm going to do 3, 4, and 5 together because they do rather run together with some of the information I'm going to share. Strategic withdrawals, supplementing income, and retirement gaps. Implementing a HECM reverse mortgage with a line of credit offers many wealth management options for the retiree because the funds complete the longevity planning puzzle by filling in the gaps. Maintain the ability to maintain your investments and avoid dipping into savings or retirement portfolios by leveraging the line of credit proceeds will increase cash flow and work as a coordinated withdrawal strategy during down markets. We've experienced this in the last 23 months. And there are a lot of people pulling from their portfolios right now that could be mitigating that depletion by accessing the equity funds that exist in their home, allowing them to stretch those retirement funds over a longer period of time. Next slide, please. 10 ways of how the line of credit, this is additional 5 may be used. Finance long-term care benefits. This is something Dawn's going to get into. Many people have not had the opportunity throughout their lifetime to prepare for this. And this is something that these funds can be utilized for. Using the line of credit to pay income tax on taxable retirement distributions. People that are in the process of liquidating or are at the age prepared to bring those in, again, are paying taxes on these tax deferred, and it raises their overall adjusted gross income. They can use these funds within the line of credit to help mitigate the taxation on that. Financially support aging in place in the comfort of your home. This is a very close to my heart feel on this. This isn't the financial piece. This is the heart piece. Being able to help people stay in the comfort of their own home when they're not in the desire to want to move on or aren't prepared to move on into an independent care or dependent care situation. They'd rather do what they can to stay at home as long as possible. And they have the equity funds to be able to do that. This is a fantastic position to put them in. To make home improvements and modifications. Sorry about the typo. I caught that too late. Travel and lifestyle. For the people that have other aspects of their financials in place, travel and lifestyle sometimes is the situation they've waited their whole lives for, and they want to take that big trip and not dip into their retirement for it. And they can utilize these funds for that purpose as well. Next slide, please. The line of credit basics, and I'm only focused today on the FHA HECM, the home equity conversion mortgage. I am not referring to proprietary products. Just so you know, there are proprietary products in the reverse mortgage space, which will work with people at age 55. And we can also discuss the spouses of somebody that's younger than age 62. You can reach out to me privately and I'm happy to address those. But for today's program, this is what I'm just using as basics. Must be their primary residence. They can own a lot of other real estate, but a reverse can only be put on their primary residence. And so therefore the line of credit as well. The mortgage should either be paid off or has a significant equity to be able to, or they can bring funds into close, such as even with a purchase, a reverse mortgage for purchase, and or a refinance. If it makes financial sense to do this, bringing funds into close. I have had a few that have done this. It made sense for them over time. And that is how they were able to close it, because their market value was less than what they were expecting. Again, the homeowner's applying for a HECM reverse adjustable rate mortgage. The line of credit is associated with the adjustable rate mortgage. If it is a fixed rate, it is going to be a one lump sum distribution. It's not, there's not a line of credit associated with that. So they would not get those benefits that they would if they were using the adjustable rate mortgage for the line of credit. Next slide, please. So this is my own personal crusade. I know that the other reverse mortgage specialists that are Learn members feel the same as I do, because we wouldn't be in this space if it wasn't important to us. But this is kind of my reverse mortgage revolution that I want people to jump on board with this, with all of us, and help bring this information to light for people so that they can enjoy the benefits of what they've worked so hard for by putting this equity away, just like they've worked hard putting their retirement funds away, and being able to utilize both for a total financial wellness picture. I just want to say thank you so much for the opportunity to share this. This is a passion for me. I really love what I do, both forward and reverse, but for the seniors and the people that this helps in retiree, and I'm one of them. This is just something that really speaks to me, and I'm very grateful for the opportunity to share this with you. Thank you.